with us, a fund manager at InCred Asset Management. Aditya, good afternoon. Good to have you here. So, it's always interesting speaking with you because you come up with ideas and you back them up with, what you're feeling about specific stuff. And we've spoken about many in the past interactions. To your mind, given this entire tariff tussle which has been going on, are there any clear kind of winners, long drawn out, but maybe valuations right now are completely discounting the potential? Anything out there?
Yes, obviously, if you have such a big disruption happening in the world, it is logical to expect that, once you have clarity, there are going to be big winners, big trends will emerge, So our view is that, obviously, for people like us who believe in doing value investing and embracing volatility, these are times wherein you can construct, very interesting portfolios from a 3-5 year perspective. And obviously, this is one of those times wherein a reset of world order is happening. I think so. What we see today is that, what does Trump 2.0 want is lower yields in the US. Obviously, that to a certain extent, is very, very clear. It is amply clear because of refinancing, lower crude oil to snap the war between Russia and Ukraine. Obviously, it benefits India. And more importantly, this is the first, crisis for a longest period of time. Even if you go back to long-term capital management collapse, you have seen softening of the dollar, which is clearly very, very positive. And that creates, enough room for the Reserve Bank to, cut rates fairly aggressively. And this is what would differentiate, a lot of emerging market central banks, because they are in a much, much better fiscal consolidation space, and that is what we believe. So the early trends which are, sort of emerging based on these sort of macro change in macro that we are witnessing, what we are trying to understand is that, wherever there is the gap between capability and, vis-a-vis, competition in China. And secondly, obviously, cost of production, you have got a real chance wherein, in India can compete globally. So we are just trying to see wherein, globally competitive companies who have been exporters for the longest period of time, obviously, they are going to benefit immensely out of the new trends which are emerging.
All right. Hi, Aditya. Good afternoon. Good to see you in. Nigel on this side. I'm looking at some of the holdings that you have, and we've spoken a lot of them in the past, be it the healthcare companies like Newland, Indraplast, that one we spoke about. We've spoken about Healthcare Global as well in the past. But I'm just looking at the financial space, and there's a, the not talked about stock, that's Arman Financial Services, which is up more than 25% in the last 1 month or so. Want to give us a couple of tidbits on this one? Why are you all positive on it?
Sure. So one of our beliefs is that, that you can buy the best companies when, the sector is completely out of flavor. I think so. The most hated sector in the market today is MFI. In the previous cycle, closer to COVID, we took this view that, Credit Access, Grameen possibly is the best managed MFI. It continues to be one of the better managed MFIs in this country. And obviously it is about, cross-cycle NPA recovery experience. So if you look at Arman in particular, it is a 32-year-old company. This is the first quarter wherein possibly, they have reported a loss. Even if you go back to the COVID year, they had managed asset quality reasonably well. If you look at their track record, it has been impeccable. 10 years back, the equity capital for this company used to be 6 crores, which is close to 10 crores today. Reserves have shot up from 37 crores to 850 crores. I think so. They are one of the better managed MFIs. It used to be a very, very Gujarat-focused MFI till 2017-18. Then they, moved out of Gujarat. Today, they are present in, close to 18 odd states in the country. And we believe that Arman is one of the better ones in terms of, managing asset quality. So we are seeing, one of the themes that we are very, very focused today on is to buy companies wherein multiples have been cut, earnings growth has been cut, and promoters are buying. It is a very, very interesting combination if you are managing money in a flat or a bear market. And this is where I think so Arman completely stands out. They are having ample liquidity. They are not as levered as their MFI peers. Obviously, we have got some of the larger MFIs like Fusion or Spandana, which obviously are much more levered. But I think so Arman will clearly stand out in terms of asset quality performance. And that is what matters in this business.
All right, we take that point. You said that, it's a good time to buy good companies when they are they're facing the sectors, we're facing a tough time. I remember sometime in the past we've had a conversation where you were positive on IT stocks, citing valuations being comfortable. Almost 6-7 months down the line, we've only seen further destruction in those valuations and the market cap, increasing uncertainty on account of what's taking place in the globe right now as well. Do you still see this as a pocket which is attractive? Are there signs of any turnaround right now? If yes, then what specifically are you backing in the IT space?
So I think so valuations clearly are, closer to, what we have seen. If you do a 10-year average multiple, IT companies have been battered so much that possibly they are trading, somewhere closer to that. Actually, with the top 5 IT companies, the real problem seems to be growth, to our mind. Dollar revenue growth trajectory of 2.5% to 3%. That sector got massively re-rated post-COVID, in the hope of, obviously IT spends picking up. We are seeing the reverse happening at this point in time, at this juncture, wherein, people are too much concerned about IT companies not doing well. Obviously, historically, IT has been a defensive sector. Today, I think so there are 2 things which are happening. One is disruption on account of, AI, which is happening all through the world, basically, and that is impacting the IT companies. But we like mid-cap IT as a space. To be very, very specific, we have favored product companies here like Intellect Design Arena or Oracle that we have held in the past. So we have created within the IT basket, we like mid-cap IT. Within mid-cap IT, we like companies which are more focused on the product side, because we believe that there is going to be 1 or 2 IT product companies, which will make it very, very big over the next decade or so. Services was a thing of the past. So we are very, very positive on the prospects of Intellect, for example, because we believe that you have a real champion in the making if you purely focus on capability. Obviously, they have been not in a position to crack US till now, but we do believe that this is going to be a very, very critical year for them. For this quarter particularly, I think so they would have the highest growth quarter, possibly, margins are going to also improve. And specifically to Intellect, I think so the balance sheet is improving because they got out of the GEM contract, and that was putting some strain on working capital as well.
All right, Aditya, we'll leave it there. Thank you very much for your time. Good speaking with you. And it's always a good conversation. Well, time for our segment, D Street Chatter.